Hey, good morning, everybody. Time for a new week. It's Monday, and a great way to start your market week off with Trader Talks. My name is Brent Moores. I'm sitting in for Kevin Horner today, who was out at a workshop event last week and is traveling today, but he should be back coming up in on Wednesday's Trader Talks. But I'm glad to be here with you, and I'm also joined by Mr. Jeffrey Abelotes. And so we're going to take you through the market action here today. Jeffrey, good morning.
Good morning, Brent. Thank you very much for having me. Always a pleasure getting to collaborate with you. Good morning as well to all of the viewers out there. I see in the comments section. Love that. Everybody's saying good morning to each other. Very friendly. I really like this space. So a wonderful day to start the week.
Yeah, we do have a friendly group here. I encourage your participation. Also, that brings to mind in the chat, we have Mr. Mike Fairborn. I've known Mike for many years now, about 20 years now, probably, better part of that at least. And he's not only a very knowledgeable coach, but he also is very helpful and a great guy, and he's there in the chat. So as you have questions, feel free to type those in the chat between Jeff and myself and Mike. We'll do our best to get to those questions. Now, before we get too far into this, let me just mention a couple things. One, you can follow Mike and myself on X at Brent Moore CS, at Mike Fairborn CS. Also, there's a few important notes that I need to mention here. One, the information today is for general informational purposes only. It's not an individual recommendation, or it's not personal investment advice. And options do carry a high level of risk and are not suitable for all investors. The paper money software application is provided for educational purposes only. And that's all it is. And everything we do today is just for educational purposes only. Schwab does not recommend the use of technical analysis as the sole means of investment research. And all investing involves risk, including the potential loss of principal. Let's see. There you go. Okay. So, hey, what are we going to do today? We're going to talk about the major market indices, as we always do in this webcast. And then we're going to talk about, we'll look at individual stocks, individual sectors, and look at different charts here today. And any, we will look at individual stocks, but they are not recommendations. Okay, so let's hit up the markets here. I'm going to start off, and just to orient everybody, I have a 20 and a 50-day moving average, typically, unless I change it on these charts. The red is the 20-day moving average. Here's the 50-day moving average. The market's just opened, and you know what this is telling me? All-time high on the S&P 500 right now. It just keeps trucking along, everybody. Higher highs, higher lows. Even though we have had some, maybe such not great news occasionally popping up in the market, all-time highs on the S&P 500. Jeff, any thoughts on the SPX here?
Yeah, I think you're right. It is hitting all-time highs. That's certainly evident right there. The thinking that I keep coming across, and I work with a lot of clients throughout the branch network in Southern California and Arizona, but a lot of the same thinking is pervasive amongst the nation, and that is like, shouldn't we have a pullback? Shouldn't something bad be going on in the market?
Yeah.
And of course, you'll see news article after news article saying why now is the time that a pullback or some recession should be hitting. They'll say, oh, look at the lumber prices, or look what's happening in housing, or look at the unemployment information that's coming out. But the fact of the matter remains, the market does like to climb a wall of worry in a lot of instances. And Brent, I think today and this ongoing saga throughout the entire summer that we've had is certainly proving the rule rather than the exception on that.
It is. I think it also points out to your point, even though there's a lot of narrative about why the market should fall, and the reality is, for technical traders, the trend or the technicals are going to be the things that may inform you as to when things are falling, not what the market chatter is or what the pundits are saying. Because I'll tell you, there's a lot of times when I think the market should be going up or going down, and certainly the market doesn't listen to me there, Jeff. And I'm
Hey, me
guessing
either,
you may
big
feel
guy.
the same way there on that one there.
Yeah. Yeah, we can have our own opinions, and I think that's great for all of us to have our own narratives and see what's happening. But it doesn't really matter what we think; it's what's the market going to do. And in this case, like you're talking about, Brent, the trend is your friend. So keep that in mind as you're
Yep.
placing your trades.
So here we go. So we've been going up, and that's on the, that's just a 6-month chart, daily chart. If we go intraday, let me do that real quick. I'm going to go to intraday, and I'm going to pull up, we'll pull up pivot points here on this, and just kind of see. I'm going to zoom in just a little bit. Here's where we opened today. By the way, on Friday we had an all-time high. We hit an all-time high intraday on Friday, and you can see we gapped up a little bit this morning on this. Here's your pivot point level. Here's your R1 level. We're kind of skirting right along that R2 level. If you're looking at an intraday chart, these are each of these right here are 1-minute candles that we're looking at here. And so kind of a, if you're, and by no means, if you're a intermediate or a longer term trader, this may not be of much importance to you right now. But if you are looking for a shorter term signal, this may be kind of a key level intraday. We've kind of skirted right along that here to start the day. We'll see if we go up or down from here. I don't know, but that's your intraday look on the S&P 500. Now, the thing is, the S&P 500 has been going up. We hit our low back in early April, but when we look at, say, when we look at the S&P 500 and we look at the percentage of stocks in the S&P 500 that are above their 50-day moving average, that actually has been declining a little bit lately. And we're at about 60% now. So more than half are above their 50-day moving average. But the norm, as what we've seen quite a bit lately, is some of the bigger companies have been a bigger factor in driving that S&P 500. Any thoughts on that there, Jeffrey?
But I think you bring up a great point, and that is it's great. It's a good idea to look at the underlying components. So when you're looking at the S&P 500, remember it's an index of different companies. What drives the index? It's those companies. So you want to find what the weighting is for each of those companies. You may focus more on them as leaders or possibly laggers. So as you're running through and you say, okay, I know that NVIDIA is a big part of the components. I know that Apple, Microsoft, Google, those ones have a bigger outstrip of what's happening in that index. That is where you may want to start to cheat as you're looking at, could we see a divergence? So for those of you out there who do like doing the research of the market, and I know there's a lot of you out there, that's your opportunity to say, what is moving the market? And if you see the S&P 500 going higher, while some of those bigger components are going lower, that may be an early warning sign that the market might be due for a potential pullback, Brent.
Yeah, I mean, I think it's a good point. And here's the heat map, and you can see some of the bigger charts. And NVIDIA is, not is kind of more mixed, not a significant number. But here you can see some of these bigger components like Microsoft, Apple. Here's Amazon down a little bit, and Tesla. But if you just look at the size of the company, here's some others as compared to a lot of these. It doesn't matter that the whole map may be. Maybe more companies here may have a little bit more of a reddish tinge to them today. Some of the bigger companies are green, and that may be more driving what we got here going on on this chart here. Let's take a peek at the NASDAQ now. Here's the NASDAQ, and again, it's kind of similar story to the S&P 500. NASDAQ all-time highs. If there were concerns about a potential resistance here, we broke through those last week, and the NASDAQ is just trucking along there. Same thing on the 1-day intraday chart on the NASDAQ. Big gap up, kind of test, and this one, if anything's just kind of taken off here a little bit more. And we have that R2 level waiting on that NASDAQ there. And we'll look at some of the individual companies that are moving in the market here in just a little bit. But what I do want to talk about is the Russell 2000, because that's been the one that has been a little bit different than the larger cap indexes. Again, the trend has been going up. This actually does not represent an all-time high, although you can see, because if we go back, this is the only major index that has not exceeded its 2004 high, 2024 highs, unlike the S&P 500 and the NASDAQ. But still, the small caps have been doing better lately. Jeff, any thoughts on the chart on the Russell 2000 there?
Well, you got to keep in mind too, the small caps tend to be a canary in the coal mine. When investors are worried, especially institutional investors, are worried about the macro, the overall outlook of the economy, it's generally those smaller, nimble companies that tend to take on more debt that they start to sell first. Now, as you're looking at this chart, Brent, you're just giving confirmation that there is still a lot of risk on appetite out there amongst big traders. So what might you look for in the next coming weeks, maybe even months? If you start to see a situation where, and you noticed on the Russell, it pulled back, found that 20, but then notice how it just caught that 50 right there in August. July, August 4th. Is that where?
Right about there.
Right there.
Yeah,
Boom.
August
You
3rd,
got it,
August
my friend.
4th, somewhere right in there. Yep.
Yeah, look at that. Found that 50 nicely, held it 1 day, 2 days, and then it continued going higher. Where might you look for a little bit of bearish divergence? That might be in a pullback through the 20 and possibly down through the 50 to say, uh-oh, we're getting a little bit of concern from these small cap companies. Let's now keep an eye on the bigger blue chip companies to see if they also follow along that path.
That's a good point. From a technical standpoint, you can have different support levels, and sometimes those support levels may be horizontal or what, but you can use these moving averages, and it seems like for the most part, the 50-day has kind of acted as a support, and then in the bigger pullbacks, that was a 20-day I was mentioning on the red. And on the bigger pullback, the 50, that would certainly be a bigger concern on that if we were to break below that 50-day moving average on that Russell 2000 chart. And, as you mentioned, Jeff, the the Russell can be sensitive to economic concerns in the market. They can also be sensitive to interest rates too. And we have seen a lowering of interest rates, which probably has helped the Russell 2000. In fact, let's take a look at interest rates here. And we actually have an event coming up this week. That we have the Fed minutes coming out and the Fed rate decision coming out this week. And, lately, the past for several months, when we've looked at Fed rate decisions, it's been kind of ho-hum in the sense that most people had a pretty strong indication the Fed was going to do nothing. This is a different scenario this time. We'll get to that in just 1 minute, but look at what's happened to interest rates here. Just a reminder, if you want to know what the actual rate is on this TNX, just move the decimal point over one spot here. So current rate is about 4.04, but that's a substantial lowering from what we've seen over the past few months. And I would say there was probably an idea that this was going to be a potential support area, or if you will, kind of a lower area for interest rates until we went down. And part of that may have been some weakening labor numbers, which probably increased the chance of rate cuts here. Any thoughts on this TNX here chart, Jeff?
Yeah, that's a really good call out. I think that does coincide with the labor numbers that came out. And it was just a few weeks ago that everybody seemed to en masse decide, well, okay, now the Fed's going to cut.
Yeah, yes.
It's not a foregone conclusion. I just want to make sure to make that clear for everybody. They haven't announced anything yet. But I do think that a lot of the question on traders' minds right now, Brent, is it going to be a 25 basis point cut, or is there enough of an argument for a 50 basis point cut? Now, whether or not they do cut, or if they cut by 25 or 50 basis points, ultimately is going to be up to the Fed.
Yes. So let's take a look at the CME Fed Watch tool. Again, this is a third-party tool that looks at basically Fed funds futures and what the market is kind of considering likelihood. And this is Wednesday, we have a Fed meeting. The current rate is 4.25 to 450. Okay, these are basis points basically, 425 to 450 basis points. basically the way the market is putting this in, and again, as Jeff mentioned, there's no guarantees on this. It is this is just how the market is positioning it. Basically a 95% chance that we get a 25 basis point cut, okay? About a 5%, so a small chance that we see a 50 basis point cut here coming up in the meeting. And, this is going to change. The other question is, how many cuts are we going to see this year? If I go to December, let's take a look at what December is saying. Remember, this is our starting point, 425 to 450. This, a 1% chance, according to the market here, of a 25-point cut through the end of the year. And that's it. 20% chance of a 50 basis point cut. And the consensus is 75 basis points, or three quarters of percent cut in the Fed funds rate here by the end of the year. So a lot of people are speculating 2, probably even 3 interest rate cuts by the end of the year. Now, you can take this the next step further. And the next step further is you can go, well, look, this is the Fed. This is what the market's kind of looking. What do the individual Fed members say? Well, we're going to see coming out on Wednesday, the Fed is going to be releasing a dot plot as well. And so what's a dot plot? Well, let me just show you here. The current dot plot, you can look at it a couple different ways, but this is what it's been in the past. Okay, so this is going to change. But when you look at the dot plot on this, the way to read this is each of these dots represents a Fed member's, voting member's view of what the appropriate interest rate, where the appropriate interest rate should be at the end of the year. So at the end of 2025. Now, as I mentioned, this is past due at this point. This is past data at this point. This will change. But what you can see is, right here is where we currently are. But right now, most people are expecting a drop on this. And so what you're going to see is these numbers shift down, likely. But what we'll be looking at is 2026. You can see some outliers. You can see a few members thinking, we're going to be below 3% at the end of 2026, down to almost 2.5% at the end of 2026. There's always some members that are more hawkish or more dovish on this. And so you can kind of get a sense for where the consensus is. And I think the lighter blue, which you can see like right there and right there, is just kind of the median expectation on that. Any thoughts on the dot plot there, Jeff?
I love what you highlighted. I wasn't aware that this was an outlook for the end of the year, so that's a really good learning for me, Brent. Thank you for sharing that.
Yeah. So anyway, that's a dot plot right there, and so that's something when the data comes out on Wednesday. Take a look at it. You may find that of interest. You may find that of interest to everybody. Let's hit up some questions here. And one, Jim says this affects short terms. Yeah, that was looking at the Fed funds rate. The Fed funds rate does not directly affect the longer term rates. In fact, last time we had a significant Fed funds rate cut, the 10-year actually went up when we had the short-term Fed funds rate. Any thoughts on the short-term rates versus long-term rates, Jeff?
Yeah. Remember, what is the Fed's funds rate? It's the overnight rate for what a bank lends to another bank. And so a lot of people say, well, it really doesn't have that big of an impact. But then you have another group that says, well, wait a second, that Fed's funds rate is going to impact potentially the 10-year. That could even impact mortgage rates. Now, I love that you highlighted that, bro. Last time they had a cut, the 10-year went up. Everybody was like, wait a second, that's not what's supposed to happen here. That is what happened there in that particular instance. So there is no guarantee that because the Fed cuts interest rates, that banks are automatically going to give us lower loan rates or that they're going to cut the mortgage rate. But it is a pretty decent indication in most circumstances of what the long-term outlook on interest rates might be.
Yes, I
We
don't
also have another question.
Yeah, go
Sorry,
ahead. I was just going to say, I don't have the time to do it right now, but in the past I've shown the rate of the Fed funds rate on the same chart as the 10-year. And there is a general correlation over time. As I mentioned, sometimes it doesn't work that way, but there is a general correlation over time of the rates going the same direction on both of those. Okay, go ahead.
The question I'm seeing ahead of that one coming from Cola is, why do you use the 20 and the 50? Very, very popular simple moving averages, but I'm always curious to learn from other traders why they use certain indicators.
Yeah, that's a good question, Cola. And the answer is kind of what Jeff mentioned is, first of all, there's no right moving averages. I think most of you know this. There's no, you'll see different people use different moving averages. The 20 and 50 are very popular. Sometimes when you look at individual charts, you may see a stock or index bouncing off a particular moving average. And maybe it's something different. And so you can certainly use that. What you can kind of say, well, in the past, the stock has bounced off this moving average, therefore I'm going to use this moving average. But just as a general set across the board, I use the 20 and 50 because in my mind, they seem to be like some of the most popular short to intermediate term moving averages. Now, there are longer term moving averages. You can go much shorter as well. But in terms of kind of, people use round numbers. Most people don't use a 45-day moving average. People are more likely to use a 50-day moving average. So that's just what I'm accustomed to and what I use and what you're going to see quite a few other people use. But I have no great, reason to say why this one is the best one that you should use. It's not the best one you should use necessarily. It's just what I use. So anyway, I know that may be an insufficient, an unsatisfactory answer for some of you, but that's the reason on that. And just let me mention something else. There's a survey link in the chat, everybody. We do appreciate your feedback on the survey, and so if you just take a minute to fill those out, that'd be great. That'd be great.
Right. Do you mind if I add something too?
Yeah.
So I talk about this in presentations all the time, but why do we have the 20, the 50, and a lot of times the 200 on charts? And it's similar to what Brent's saying, because everybody else is using it. That's why. Yeah, we're all looking at it, so we're using it. But I think the general feeling as to why they picked those three terms was 20 represents about a month's worth of trading, 50 is about a quarter, and then 200 is about a year. Now, those aren't the exact numbers. There's actually 252 trading days in the year. But again, like Brent said, people like the round numbers. It just makes things a little bit easier. Here's a fun fact, too, for all of you. If you go back to the 1950s, they weren't using the 20 to 50 and the 200. Why? They didn't have calculators. Nobody had calculator in their pocket ready to go. So what was a popular moving average back in the 1950s? It was actually the 10-period simple moving average, for those of you who are fans of history.
I was not aware of that. That's great. That's great, Jeff. Wonderful. Hey, let's move on and let's just take a look. We talked about interest rates and, let me just mention one more thing on interest rates. The Federal Reserve has what's called the dual mandate. Okay, the dual mandate is that their primary responsibilities are to take care of inflation and like labor in the economy. And so one reason they've been a little bit more reluctant to cut the Fed funds rate is fear of kind of increasing inflation, because we've struggled with inflation a little bit, and that's fine, but we've seen some weakening labor numbers as well here, and so there is more of an incentive to cut if the labor market is weakening here. Right now, with the idea of the cut, there may be a little bit more of an emphasis on the labor side of that dual mandate than the inflation concern side of that dual mandate here. So just wanted to add that to that. That's kind of when the conversation is, should the Fed cut? Should the Fed not cut? Those are the two main things that the Fed is looking at and considering when they're doing that. Okay. All right. Let's move forward. Let's just take a quick look at the VIX. Here's the VIX right around 15, which is pretty close, I think, to to an average historically. Lower than we've been for a lot of the year, though, because hey, look, there's been more uncertainty this year. Probably not surprising that the VIX is a little bit lower there on that. Let's look at some other asset classes here, and then we'll look at some individual stocks as well that are in the news. Here is gold. Jeff, what are you seeing on the gold chart here?
It's just incredible. I was talking to a client who had put a lot of the portfolio in gold probably about a year or so ago and was saying, oh, this is my reasons. And he had a thesis. And I said, all right, well, let's see what eventually happens. I am truly surprised by how well gold has been performing, not just for the last year, but just look at the last 2 months, especially. Big green up days moving higher and higher and higher. And I certainly am not a gold expert, so I kind of wonder myself, what is driving all of this demand for gold and for underlying components that have access to it? And I guess I'm curious, Brent, is there anything that you're reading out there, something that's coming across your desk that might be creating this sort of a movement in an ongoing basis?
I don't have any particular expertise. I think that there may be partially, something you mentioned earlier is there's some concerns with the equity markets of them maybe being a little highly valued, put it that way. And, where do you put your money if you're a little bit concerned for equity valuations? Well, gold may be one logical place for that. Often we'll talk about gold as kind of a place for a flight to safety, if you will.
Right.
And so I don't know. I don't have a particular knowledge of that, but people are buying it, and not just people, but governments. Central banks are buying it too, and that can certainly drive gold prices. Gold is also an inflation hedge that people will use. So if you're concerned on those fronts, you can see that going up. But it is kind of strange. A lot of times gold performs better when people are very concerned about the market, the equity market, and the market's going down. Well, we have the concern about the equity market, but the equity market's going up. We already saw that there. So anyway.
It's very intriguing. Yeah, and so I love we have viewers out there commenting, hey, shout out to Mr. Item. Good to see you, big guy. But it is intriguing to see what is happening in the gold market and how there's this, wait a second, shouldn't gold be doing better in softer environments, not as this nice big bull rally that we've had? So yeah. I love to see some of the comments that are coming through here.
Yeah, absolutely. And we've also seen someone who was a Gary said silver as well. Here's silver. Here's a chart on silver. Silver's screaming up higher. Silver, of course, has more industrial uses. And some of this, concerns about the dollar. Here's what the dollar has done. The US dollar has done. It's going to make your European travel plans a little more expensive, everybody, probably. But this is what the dollar has done of late. And there's certainly pros and cons, to a weaker dollar. For these US multinational companies that are selling abroad, that's kind of a nice thing to have a lower dollar here on this. But we've seen the dollar lower significantly, and it's kind of staying down, maybe plateaued a little bit here. But that could be helping to drive there's a concern about the strength of the dollar. Well, what's been strong? An alternative currency, so to speak, maybe gold in that regard.
Mm-hmm. Yeah, good tie-in.
Okay. Let's see. Any questions? I like Hanu Trading said, the why doesn't matter. The price is moving higher. And that's kind of what I was trying to say earlier on the equity markets as, we can scratch our heads a little bit, Jeff, in terms of why the markets are going higher, why the SPX is going higher. But the fact is, it is. And so for a lot of technical traders, until the trend breaks, they may be, that's an area that they are maybe of interest here. Now, let's go and look at some individual companies here. Couple in the news. NVIDIA, how's it holding up today? NVIDIA's down about 1% today. News on NVIDIA. Chinese regulators had a preliminary, I don't know what you call it, investigation or determination that NVIDIA was violating the Chinese anti-monopoly rules. I'm no expert on Chinese law by any means. That's the headline I was reading. And NVIDIA's down a little bit on a day that's where the market's otherwise up. I think from a technical standpoint, we've seen a little bit of a softening here on NVIDIA. We've seen some lower highs. We've seen some lower lows as well. There's a low. There's a low. We'll see where we go from here on this. But some weakening on NVIDIA in the midst of some overall strength in the market. This certainly is diverging a little bit from where a lot of the market is going right now.
Good call out. That's what I was kind of alluding to a little bit earlier, everybody, when I was saying is the S&P is marching higher. One of the larger components isn't going in the same lockstep that it is with the overall index. So keep an eye out for this. That one's got some intrigue, I think, amongst a lot of traders.
Yeah, let's look at another company that is in the news here, and that is Tesla. Wow, for a company that has had some rough times over the past, 6 months or so last year, we've really rocketed up on Tesla. And some news on Tesla. Number one, Elon Musk just purchased 2.57 million shares, of Tesla. That's I guess, a vote of confidence in the company when your CEO is buying 2.5 million shares of the company. And Barclays expects Tesla Q3 deliveries of 465,000 units, which is above the consensus estimate of 430,000 units. So the CEO's buying, not just the CEO's buying, but a very high-profile CEO's buying a lot of shares. And not just any CEO, right? But also upgrades. And so, and some more positive deliveries numbers there on that. And companies jumping up here. Jeff, any thoughts on Tesla?
Well, from a chartered market technician standpoint, from the technical analysis standpoint, when you see a run up like this with this big gap. So I was doing some research. This comes from Tom Bolkowski, third-party non-affiliate. If a breakout up or down is accompanied by a gap, which we are seeing here on Tesla, performance improved 68% of the time. Okay, so I know a lot of us think like, oh, this can't keep going. The research shows that a majority of the time it actually does continue going. Now, what might you look for? This probably could come to be a bit of a flag pattern where it goes up, takes a little bit of a breath, starts to pull back just ever so slightly, maybe even forming a pennant. And then what happens from there? It continues on. How much would it continue on? Look for the flagpole. That level from where it started, we'll call it about 350 up to 425. So what's that, $75 or so? That might be the next possible range if it were to break out above after a flag pattern is formed. So that's something you might want to keep your eyes on out there for those of you Tesla traders.
Good point out there, Jeff. Great, thank you. And I want to look at a couple other charts, kind of the same in the same vein here. Let's look at Google, Alphabet, and Oracle as well on that. But I will admit, I have that same internal feeling of when I see the stock gap up like that, of, oh, it's gone up so far, it's going to pull back. It's interesting, the stats, though, that you brought up, not the case necessarily. Of course, we don't know. Any individual stock can be different here. But here's Alphabet. What about the Alphabet chart here?
Well, same thing. So in this case, you didn't have a big movement and then a gap up. You just had a big gap up. And the research showed that if the price breaks upward and then comes down to the breakout point, we're going to look at Oracle in a second, which will relate to this, it hurts future performance 97% of the time. But in the case of Google, where you have an upward breakout that continues, that actually helped performance 91% of the time. So this is falling directly in line with what the statistics would suggest, and that is it gapped up, it stayed up. Chances are it's going to keep on going. So that's what we're seeing here on Google. And I think, again, it's just natural for a lot of us to say, oh, it's going to revert back to the mean. It's going to come back down. That was an over exaggeration. Not necessarily the case as being shown by what we're seeing in Alphabet today.
Okay, and here's Oracle, had the gap up, Jeff.
Yep.
Came down, a little bit of a bounce here. I don't know.
Yeah, we'll see what ends up happening. It's going to shake out, but you notice the performance is not as good as Google's, where Google gapped up, stayed up, Oracle gapped up and started pulling back down. You even have that big bearish candle gobbling up the previous day's movement. So that would fall in line with the research showing that plus 90% of the time, it's going to hurt performance moving forward. Now, the research didn't say it's going to come back down to where it was before at that 250 level, but it is saying it's going to hurt the performance, i.e. it won't be doing as good as something like a gap up, stay up.
Yeah, so kind of bearish engulfing there on that. So those are great stats there, Jeff. Thank you very much for that. Let me just double check. Let me mention a couple things. As I mentioned before, we have the Fed decision, and we actually have some interest in that Fed decision this year. Some uncertainty perhaps this time around, but often the bigger thing is what's going to be the guidance for the future. Just to kind of circle back to that Fed thing. That's Wednesday. On Tuesday, tomorrow, we do have retail sales numbers coming out. Retail sales have kept up pretty strong, and so we'll see what tomorrow brings. But that's another data point that could certainly affect the markets next week here. Now, I want to look at some other companies that are in the news here with upgrades and downgrades. Let me just get to my little list here. Let's take a look at Union Pacific, which has been upgraded. Hold on, I got the wrong ticker on there. That would UNP. There we go. That's looking right. Not doing much. Not much to do there on that. City analysts upgraded Union Pacific to buy from neutral with a price target of 251. Well, we'll see what happens, but that's not. That doesn't seem to be encouraging the market that much on this right now. We broke down. I think before the breakdown, we would have been, at least a lot of traders would have thought, oh, potential support level, maybe around the 220 level or just below, but we went right below that. So, and the trend is down on this. Your moving averages sloping down. I'm not seeing a lot of technical cheer in this stock here today.
Not looking like it. Not yet anywhere.
Okay, let's look at an upgrade. Excuse me, that was an upgrade. Let's look at a downgrade here. Let's go to Under Armour here. And Under Armour, for years it seemed like was like nipping at the toes of Nike a little bit, at the heels of Nike, I guess is the way that is. Not so hot lately, though. They've certainly hit their struggles on this. Under Armour, Rothschild and company Redburn downgraded Under Armour to neutral from a buy with a price target of 6, down from 7. And so again, I don't know. That's not a great chart. We've hit here. This was probably kind of maybe a support level. We'll see if we can recover that at the end of the day. And it's not right now. The chart is certainly struggling quite a bit on that. So there's a couple. Let me just see if there are any other big name downgrades. Simon Property Group is another downgrade. The trend has been going up though. Evercore ISI downgraded Simon Property to inline from outperform with a price target of 187. So basically where we're at right now. And again, the company's kind of shrugging that off a little bit there on
That
that.
50 seems to be getting a ton of attention when it does have its struggles on this upward movement.
Yeah.
So for the traders out there that might be making a play on this, if you've got enough wiggle room, you could possibly look at that 50 as a potential support level. But still, really nice moving upward trend going all the way from 140 up to 185 in pretty decent stair-step fashion.
Yep. And let me just move on and just want to look real quick at some sectors here as we're going. This is over the last month, communications has been just rocking, doing really strongly. Real estate, well, actually, discretionary has been doing fairly well over the past month. Those have been the top performing sectors over the past month. And consumer staple, excuse me, that'd be staples, has not been doing very well over the past month. And utilities, not so much over the past month. We'll see. Utilities potentially could benefit from an interest rate cut, though. We'll see the general trajectory of interest rates there. In terms of sectors, there we go. I think I'm going to have to leave it there because we're going to be running out of time here. But before we wrap up, there's a couple more things I want to mention. One, you can always follow us on YouTube, subscribe to YouTube, the Trader Talks channel. If you're watching YouTube right now, bottom right portion of your screen, if you have not already subscribed, it should give you the opportunity to subscribe. That way, you're not going to miss future content. Also, we appreciate a thumbs up. It not only helps our channel, it helps promote free education here for you, free quality investor education there. And it also makes me feel good and your instructors feel good when you get the thumbs up. And then finally, Jeff, I want to talk to you. I just want to hear, what do you inform everybody what you do when you're not on Trader Talks here. What's your day-to-day job here?
Well, I generally meet with clients in the branch in our Southern California and Arizona regions. I do presentations. So if you're in the La Jolla area on Wednesday, I will be in La Jolla doing an advanced options presentation for the clients out there. Thursday, I think I'm going to be in Mission Viejo, and then Friday I might be in a different branch in California. But I have the pleasure of doing the in-person experience. So not only do you get wonderful virtual experiences like the one you're viewing now, you also have the opportunity to go into branches. So if you're wondering, when is a workshop like this going to be coming to a branch near me, reach out to your financial consultant or call the local branch, and they'll be happy to share that with you. Thanks for asking, by the way.
All right. Hey, thank you, Jeff, for joining me. Thank you, Mike, for helping us out in the chat. Just a reminder, there is a survey link in the chat. We do appreciate your feedback and suggestions on those. And everybody, hope you have a wonderful week ahead. And we'll see you all down the road here. So bye-bye, everybody.